What drives human civilization forward? What motivates exploration, innovation, war, and peace? What single force has shaped the rise and fall of empires throughout history? The answer, according to historian Robert Sobel, is surprisingly simple: the pursuit of wealth. The Pursuit of Wealth is not your typical personal finance book. This is a sweeping historical narrative that traces humanity's relationship with money from ancient times to the modern era. Sobel, one of America's preeminent business historians, reveals how the desire for wealth has been the invisible hand guiding human progress, driving both our greatest achievements and our darkest moments. The quote on the cover from Baron von Rothschild captures the essence. "Buy when there is blood in the streets." This isn't just investment advice. It's a window into how the wealthy have understood and exploited economic cycles throughout history. The pursuit of wealth isn't just about personal enrichment. It's the engine that has powered exploration, funded wars, built cities, and toppled governments. Over the next 30 minutes, we're taking a journey through history to understand how wealth creation has evolved. You'll discover how ancient merchants operated, how medieval traders revolutionized commerce, how industrial titans built empires, and how modern financiers shape the global economy. You'll learn the timeless patterns that repeat throughout history and the lessons that apply to wealth building today. This isn't just history. It's the blueprint for understanding how wealth actually works at the deepest level. Let's begin this incredible journey through time. Ancient wealth, the birth of commerce. Sobel begins in ancient Mesopotamia, where the concept of wealth first took organized form. Before money, wealth meant land, livestock, and stored grain. But the Mesopotamians invented something revolutionary: credit and interest-bearing loans. Clay tablets from 3000 BCE show sophisticated lending agreements. The pursuit of wealth through financial leverage is literally ancient. The invention of money itself transformed human civilization. Instead of bartering goods directly, standardized currency allowed specialization, trade, and accumulation. The Lydians created the first coined money around 600 BCE, and suddenly wealth became portable, measurable, and exchangeable across vast distances. Ancient Egypt demonstrated how wealth and power intertwine. The pharaohs controlled grain production, the primary wealth of agricultural society. By monopolizing grain storage and distribution, they accumulated enormous wealth and absolute power. This pattern of controlling essential resources to build wealth repeats throughout history. The Phoenicians pioneered the next wealth revolution: long-distance trade. These master merchants built ships, established trade routes, and created the first international commerce networks. They understood a principle that remains true today. Whoever controls trade routes controls wealth. Their pursuit of profit drove them to explore the Mediterranean and beyond, spreading commerce and culture. Ancient Greece introduced another wealth concept: entrepreneurship and innovation. Greek city-states competed economically, spurring innovation in everything from ship design to banking. The port of Athens became a financial center where merchants, ship owners, and traders gathered. The Greeks even developed early forms of insurance. Ship owners would spread risk by taking shares in multiple vessels rather than owning one outright. Rome perfected the infrastructure of wealth. The Romans built roads, aqueducts, and legal systems that facilitated commerce across their empire. They understood that Wealth creation requires reliable infrastructure and enforceable contracts. Roman law protected property rights and enforced agreements, foundations essential for any economy. Sobel emphasizes a crucial lesson from ancient wealth. Those who understood systems, whether grain distribution, trade routes, or infrastructure, accumulated wealth far beyond those who simply worked hard. The pattern was established. Systematic thinking about wealth creation beats individual labor. The fall of Rome demonstrates wealth's fragility. When infrastructure crumbled, trade routes became dangerous, and legal systems collapsed, wealth evaporated. This illustrates a timeless truth. Wealth depends on stable systems. Without them, even great fortunes disappear. Medieval merchants, the rise of trading empires. The medieval period saw wealth creation shift to merchants who rebuilt trade networks after Rome's collapse. Sobel focuses on the Italian city-states, Venice, Genoa, and Florence, where merchant families built trading empires that rivaled kingdoms in wealth and power. The Venetians mastered maritime trade, establishing monopolies on routes to the east. They imported spices, silk, and luxury goods, marking them up enormously for European customers. The Venetian pursuit of wealth drove them to establish colonies, control shipping lanes, and even finance crusades that opened new trade opportunities. The Medici family of Florence revolutionized banking. They invented double-entry bookkeeping, developed letters of credit for travelers, and established the first international banking network. The Medicis understood that financing trade was more profitable than conducting trade. The lender earns interest while taking less risk than the merchant. This period introduced another wealth principle. Information asymmetry creates profit. Merchants who knew market conditions across multiple cities could buy low in one location and sell high in another. Those who received news first, whether of harvests, wars, or political changes, could act before others and profit from their knowledge advantage. The Hanseatic League demonstrated the power of organized commerce. This confederation of merchant guilds dominated trade across northern Europe, creating the first true commercial alliance. They negotiated treaties, maintained private armies, and controlled entire regional economies. Individual merchants joining the League gained wealth through collective power. Medieval wealth also revealed the importance of relationships. Merchant families intermarried, creating networks of trust and mutual interest. Business was conducted through personal relationships backed by reputation. Betraying trust meant exclusion from these networks, a death sentence for a merchant's business. Sobel emphasizes that medieval merchants faced enormous risks: piracy, shipwrecks, wars, and political instability. Successful merchants managed risk through diversification, insurance, partnerships, and political connections. They pursued wealth aggressively, but protected it carefully. The period also showed how pursuing wealth drives innovation. Merchants funded improvements in navigation, ship design, and accounting. The desire for profit motivated the development of business tools we still use today. The age of exploration. Wealth drives discovery. The pursuit of wealth drove humanity's greatest age of exploration. Sobel explains that exploration wasn't about curiosity. It was about finding faster, cheaper routes to valuable goods and discovering new wealth sources. Portugal and Spain launched expeditions seeking direct routes to Asian spices, eliminating Italian middlemen who controlled overland routes. The Portuguese success in reaching India by sea around Africa broke Venetian monopolies and shifted wealth from Mediterranean city-states to Atlantic powers. Christopher Columbus's voyage was fundamentally a wealth-seeking venture. He convinced Spanish monarchs to fund his expedition by promising a faster route to Asian riches. His discovery of the Americas was an accident in pursuit of profit, but it unleashed the greatest wealth transfer in history. The Spanish pursuit of wealth in the New World was single-minded and brutal. They extracted enormous quantities of gold and silver from American mines, shipping treasure fleets back to Spain. This influx of precious metals made Spain temporarily Europe's wealthiest nation. But Sobel notes, it also caused massive inflation, demonstrating that raw wealth without productive capacity creates problems. The Dutch pioneered corporate wealth creation through the Dutch East India Company, history's first publicly traded corporation. Investors bought shares, spreading both risk and profit. This innovation allowed raising enormous capital for expensive, risky ventures. The company became so powerful it maintained armies, negotiated treaties, and governed territories. A corporation state pursuing wealth globally. The British East India Company followed the Dutch model, but ultimately surpassed them. At its height, this company controlled the Indian subcontinent, not as British territory, but as corporate property. The pursuit of wealth by a private company literally conquered nation. This demonstrates wealth's power when organized systematically and backed by military force. Sobel emphasizes that the age of exploration fundamentally transformed global wealth. Europeans accessed resources, labor, and markets globally, while colonized regions had their wealth extracted. The patterns established, resource extraction from periphery to center, shaped global economics for centuries. The period also revealed the importance of technology in wealth creation. Better ships, navigation tools, and weapons gave Europeans decisive advantages. Those who invested in technological superiority gained wealth. Those who didn't fell behind. This era established another pattern. First-mover advantages in new markets create enormous wealth. The first to establish trade relationships, the first to exploit resources, and the first to claim territories gained disproportionate benefits. Industrial Revolution, transforming wealth creation. The Industrial Revolution completely transformed how wealth was created, moving from trade and land ownership to manufacturing and industrial production. Sobel argues this was history's most dramatic economic transformation. The revolution began in Britain with textiles. Inventions like the spinning jenny and power loom multiplied productivity exponentially. A single worker operating a machine could produce more than dozens of hand workers. Factory owners who adopted these technologies early built enormous fortunes while traditional craftsmen were displaced. The steam engine revolutionized everything: manufacturing, transportation, and mining. Those who recognized steam power's implications and invested early became wealthy. The Watt engine powered factories that produced goods faster and cheaper than ever before, creating massive profit margins for factory owners. Railways demonstrated how infrastructure investment creates wealth. Building railways required enormous capital, but generated massive returns. Railway magnates became some of history's wealthiest individuals. Railways also created wealth throughout the economy by reducing transportation costs, opening new markets, and enabling national economies to function efficiently. Sobel focuses on several industrial titans who exemplified the era's pursuit of wealth. Andrew Carnegie understood that controlling raw materials and production meant controlling profits. He built vertically integrated steel operations, owning mines, ships, railways, and factories. This eliminated middlemen and maximized profit margins. Carnegie's pursuit of efficiency and scale built one of history's great fortunes. John D. Rockefeller applied similar thinking to oil. He recognized that whoever controlled oil refining controlled the industry. Through aggressive acquisition and ruthless competition, Standard Oil came to control 90% of American oil refining. Rockefeller understood that monopoly power creates pricing power, which creates enormous wealth. Cornelius Vanderbilt dominated transportation, first with shipping lines, then with railways. He pursued wealth through consolidation, buying competitors, and creating integrated transportation networks. His approach was simple: control infrastructure, charge tolls, accumulate wealth. The industrial period revealed new wealth principles. First, technology and innovation multiply productivity, creating massive profit opportunities for early adopters. Second, scale matters. Large operations have cost advantages that small operations cannot match. Third, controlling key resources or infrastructure creates enduring competitive advantages. The era also showed wealth's dark side. Industrial fortunes were built on harsh working conditions, child labor, and environmental destruction. The pursuit of wealth without ethical constraints created human suffering that eventually provoked reform movements. Sobel emphasizes that industrial wealth required different skills than mercantile wealth. Industrial titans needed to understand production, logistics, finance, and scale. They built organizations, not just trading relationships. They thought systematically about optimizing entire production processes. The period also demonstrated how wealth pursuits drive technological progress. The desire for profit motivated invention and innovation. Entrepreneurs invested in research and development because technological advantages translated directly to profit advantages. By the early 20th century, industrial wealth had created unprecedented inequality, but also unprecedented total wealth. Living standards rose dramatically, even as wealth concentrated. The pursuit of industrial wealth transformed society completely. Financial capitalism. Money multiplying money. The late 19th and early 20th centuries saw the rise of financial capitalism, where wealth creation shifted from producing goods to manipulating capital and financing production. Sobel argues this transformation created even more concentrated wealth than the Industrial Revolution. J.P. Morgan exemplified the era's financial titan. He didn't produce steel, railways, or oil. He financed those who did, taking ownership stakes and organizing industries. Morgan's genius was recognizing that controlling capital meant controlling industry. By financing Carnegie, he ultimately acquired Carnegie Steel, creating U.S. Steel, history's first billion-dollar corporation. Investment banking became central to wealth creation. Banks raised capital by issuing stocks and bonds, taking fees and equity stakes. They organized mergers, consolidated industries, and financed expansion. Those controlling finance controlled which businesses succeeded and which failed. The period saw the emergence of trusts and holding companies, legal structures that concentrated control while spreading ownership. A trust might control dozens of companies through interlocking directorates and ownership stakes. This allowed small groups to control enormous economic power. Sobel details how financial markets became wealth creation machines for those who understood them. Stock markets allowed raising capital from public investors while maintaining control through majority stakes. Savvy financiers could build empires with relatively little personal capital by leveraging other people's money. The period also saw speculation become a major wealth source. Fortunes were made and lost in market bubbles and crashes. Those who timed markets correctly, buying low and selling high or profiting from crashes, accumulated enormous wealth. Baron von Rothschild's advice to buy when there is blood in the streets came from this era. The Rothschild banking dynasty demonstrated international financial power. Operating across Europe, the Rothschilds financed governments, facilitated international trade, and profited from wars. They understood that financing both sides of conflicts was good business. Their information networks and international coordination gave them persistent advantages. Sobel emphasizes several financial wealth principles that emerged. First, leverage amplifies returns. Borrowing money to invest can multiply profits, though it also multiplies risks. Second, information advantages in financial markets create profit opportunities. Knowing news before others allows trading on that information. Third, controlling capital flows means controlling economic power. The era revealed wealth's increasing abstraction. Industrial wealth came from tangible production. Financial wealth came from paper assets, debt instruments, and equity stakes. Money itself became the primary commodity, manipulated for profit. The period also demonstrated financial wealth's instability. The panic of 1907 showed how financial crises could destroy wealth rapidly. Banks failed, markets crashed, and fortunes evaporated overnight. This instability eventually prompted government regulation and central banking. The Great Depression proved financial wealth's vulnerability to systemic collapse. When markets crashed in 1929, paper wealth disappeared. Those who held diversified assets, real estate, and productive businesses survived better than those holding only financial instruments. Sobel's key lesson from financial capitalism: wealth at this level isn't about working harder or even producing more. It's about understanding systems, controlling capital flows, and operating at scales where small percentage advantages multiply into enormous absolute profits. The modern era, globalization and digital wealth, the post-World War II era, brought unprecedented global wealth creation through globalization, technology, and financial innovation. Sobel traces how wealth pursuit adapted to new realities. The Marshall Plan demonstrated how investing in others' prosperity creates mutual wealth. America financed European Reconstruction, which created markets for American goods and strengthened allies. This enlightened pursuit of wealth, building prosperous trading partners, contrasted with earlier colonial extraction models. Multinational corporations became wealth creation engines. Companies like IBM, General Electric, and later Microsoft operated globally, accessing markets, resources, and labor worldwide. This scale created enormous efficiencies and profits. The rise of Japan and later Asian economies showed how manufacturing process could build national wealth. Countries pursuing export-led growth strategies built enormous wealth by producing goods for global markets. The Asian tigers demonstrated that Catching up economically required focusing on wealth creation through production and export. Technology wealth emerged as dominant. Computer and software companies created more wealth faster than any previous industry. Bill Gates, building Microsoft, became the world's richest person by creating software that powered billions of computers. Technology wealth differed from industrial wealth. It scaled infinitely with minimal marginal costs. Sobel emphasizes how digital technology changed wealth creation fundamentally. A software product could be copied infinitely at zero cost, creating unprecedented profit margins. Information technology allowed coordination at global scales, enabling multinational operations that would have been impossible previously. The Internet created entirely new wealth categories. E-commerce companies like Amazon revolutionized retail. Search engines like Google monetized information organization. Social media platforms monetized attention and connection. These companies created trillion-dollar valuations by controlling digital infrastructure. Financial innovation continued accelerating. Derivatives, hedge funds, private equity, and venture capital became major wealth sources. Sophisticated investors used complex financial instruments to generate returns uncorrelated with traditional markets. Globalization allowed regulatory arbitrage. Companies could locate operations wherever regulations were most favorable. This created new wealth opportunities while sparking debates about fairness and responsibility. The period also saw wealth become increasingly concentrated. The top 1% captured a growing share of economic gains, creating levels of inequality not seen since the Gilded Age. This concentration came from winner-take-all effects in technology and finance, where dominant positions captured disproportionate value. Sobel notes that modern wealth pursuit operates at speeds impossible previously. Information travels instantly, capital flows globally in seconds, and fortunes are made or lost in hours during market volatility. Wealth cycles, patterns that repeat. Throughout history, Sobel identifies recurring patterns in wealth creation and destruction. Understanding these cycles provides insight into current and future wealth dynamics. The boom and bust cycle appears repeatedly. Periods of rapid wealth creation through new technologies or opportunities inevitably lead to speculation, overinvestment, and eventually crashes. The pattern repeated in the 1929 crash, the dot-com bubble, and the 2008 financial crisis. Recognizing cycle stages allows positioning for profit, buying when others panic, selling when others are euphoric. Innovation cycles drive wealth creation. New technologies, whether steam power, electricity, computers, or internet, create enormous first-mover advantages. Those who recognize emerging technologies early and position themselves accordingly build fortunes. Latecomers compete in mature, lower-margin markets. Concentration and consolidation cycles repeat. Industries start fragmented with many players, then consolidate as larger entities acquire smaller ones. This consolidation creates wealth for those selling businesses and for those building dominant positions. Eventually, consolidation triggers regulatory responses or disruption from new technologies. Geographic wealth shifts demonstrate long-term cycles. Economic dominance moved from Mediterranean city-states to Atlantic powers to industrial nations to modern economic centers. These shifts take decades or centuries, but fundamentally reshape global wealth distribution. Recognizing these shifts allows positioning for long-term wealth growth. The wealth-to-rent-seeking cycle appears repeatedly. Wealth creators build fortunes through innovation and value creation. But subsequent generations often focus on protecting and extracting value from existing positions rather than creating new value. This rent-seeking eventually creates opportunities for disruptors who create value again. Sobel emphasizes that debt cycles profoundly affect wealth. Periods of easy credit allow leveraged wealth building. When debt contracts, wealth collapses. Understanding credit cycles helps position for both expansion and contraction phases. Regulatory cycles follow wealth concentration. When wealth becomes too concentrated and excess is too obvious, political reactions create regulation. These regulations constrain some wealth-building strategies while creating opportunities in newly structured markets. Timeless principles of wealth. From his historical survey, Sobel extracts timeless principles that apply regardless of era or economic system. First principle: wealth follows value creation. Throughout history, those who created genuine value, whether through trade, production, innovation, or service, built enduring wealth. Those who simply extracted or redistributed value without creating it rarely maintained wealth long term. Second principle: information advantages create profit opportunities. From medieval merchants knowing distant market conditions to modern traders with faster data feeds, those who know things others don't can profit from that knowledge gap. Building information advantages remains a powerful wealth strategy. Third principle: control of scarce resources creates wealth. Whether Roman grain, Venetian spice routes, Rockefeller's oil, or modern technology platforms, controlling what others need allows charging premium prices and building wealth. Fourth principle: leverage amplifies results. The Medicis used financial leverage. Industrialists used production leverage. Modern companies use technology leverage. Understanding and applying leverage carefully multiplies wealth creation beyond what individual effort achieves. Fifth principle: scale provides advantages. Large operations have cost efficiencies, market power, and resources unavailable to small players. Building scale or joining scaled organizations creates wealth opportunities. Sixth principle: timing matters enormously. Buying assets when they're cheap and selling when they're expensive creates wealth regardless of the asset. Entering industries early in their growth phase creates advantages impossible to achieve later. Recognizing when to enter and exit is crucial. Seventh principle: risk and return correlate. Throughout history, the biggest fortunes came from taking calculated risks that others avoided. Conservative approaches preserve wealth, but rarely create great wealth. Understanding risk management, how to take risks without risking ruin, is essential. Eighth principle: networks and relationships facilitate wealth. From medieval merchant guilds to modern business networks, relationships provide information, opportunities, partnerships, and support. Deliberate network building enhances wealth creation. Ninth principle: adapting to change creates opportunities. Those who recognized and adapted to shifts, industrial revolution, globalization, digitalization, built fortunes. Those who clung to old models lost wealth. Staying flexible and forward-looking is essential. 10th principle: protecting wealth requires different skills than building it. Sudden wealth often disappears quickly without proper protection. Legal structures, diversification, and risk management protect accumulated wealth. Sobel emphasizes that These principles operate consistently across time and cultures. The specific tactics change. No one is building spice trading empires today, but the underlying principles remain constant. Understanding these principles provides a framework for wealth building regardless of current conditions. Lessons for today: applying historical wisdom. Sobel concludes by applying historical lessons to contemporary wealth building. The patterns from history offer practical guidance for modern wealth pursuit. First, recognize we're living through a technological revolution comparable to the Industrial Revolution. Digital technology, artificial intelligence, and biotechnology are transforming wealth creation. Those who position themselves in these emerging fields have first-mover advantages similar to early industrial entrepreneurs. Second, globalization continues creating opportunities. Access to global markets, resources, and labor remains available to those who think internationally. Building businesses or careers with global dimensions provides scale advantages. Third, financial literacy is more crucial than ever. Complex financial instruments, global markets, and rapid capital flows mean those who understand finance can build wealth. Others cannot. Investing in financial education pays enormous returns. Fourth, information advantages remain powerful. In an information-saturated world, the advantage comes from filtering, analyzing, and acting on information faster than others. Building these capabilities creates persistent competitive advantages. Fifth, network effects dominate modern wealth creation. Platforms, marketplaces, and communities that connect people or businesses can grow exponentially with minimal marginal costs. Identifying or creating network effect businesses offers extraordinary wealth potential. Sixth, brand and reputation matter more than ever. In crowded markets, those with strong brands charge premium prices and attract customers, employees, and partners. Deliberately building valuable brands creates wealth. Seventh, multiple income streams provide security. Just as medieval merchants diversified across multiple trade routes, modern wealth builders should diversify across multiple income sources: employment, business, investments, intellectual property. Eighth, tax strategy remains crucial. The wealthy throughout history minimize taxes legally through structures, locations, and strategies. Modern tax codes offer similar opportunities for those who understand and use them properly. Ninth, investing in infrastructure and systems creates enduring value. Whether Roman roads or digital platforms, infrastructure provides lasting competitive advantages and wealth generation. 10th, timing market cycles remains powerful. Recognizing when markets, assets, or industries are undervalued or overvalued allows buying low and selling high. This requires patience, capital reserves, and contrary thinking. Sobel's ultimate lesson: wealth building isn't mysterious or random. It follows predictable patterns, responds to consistent principles, and rewards those who understand these dynamics. Historical knowledge provides perspective that creates practical advantages. So, there you have it. Robert Sobel's incredible journey through the history of wealth, from ancient Mesopotamian merchants to modern tech billionaires. What seemed like disconnected historical facts reveals a clear pattern. The pursuit of wealth has driven human civilization, and certain principles operate consistently regardless of era. Notice what remains constant across millennia. Those who create value, leverage resources, understand systems, manage risk carefully, and adapt to change build lasting wealth. Those who simply work hard without strategic thinking rarely escape subsistence, regardless of effort. This isn't fair, but it's historically consistent. The most powerful insight from this historical perspective is that today's wealth-building opportunities aren't unique. They're the latest iteration of patterns that have repeated for thousands of years. The specific tactics change, but the underlying dynamics remain the same. This means you can apply lessons from Venetian merchants, industrial titans, and financial moguls to your wealth building today. Understanding what worked across history provides a blueprint that transcends current fads and trends. Here's your action plan. First, study one historical period from this summary in more depth. Understand how wealth was created in that era and identify the transferable principles. Second, identify which current trends parallel historical patterns. Are we in an innovation boom like the early Industrial Revolution? Are we seeing consolidation like the Gilded Age? Understanding where we are in historical cycles informs strategy. Third, apply timeless principles to your situation. How can you create genuine value? Where do you have information advantages? What scarce resources can you control or access? How can you apply leverage? These questions, answered thoughtfully, guide wealth-building strategy. Fourth, study those building great wealth today and identify which historical patterns they're following. You'll find they're rarely doing anything fundamentally new. They're applying old principles to new contexts. Fifth, position yourself in emerging areas where wealth is being created. Just as fortunes were made by those who recognized industrialization's potential early, fortunes today go to those who position in emerging technologies, markets, and opportunities early. Remember Sobel's central message. The pursuit of wealth isn't about greed or selfishness. It's the engine that has driven exploration, innovation, and progress throughout history. Those who pursue wealth strategically and ethically contribute to societal advancement while building personal prosperity. Thanks for watching this journey through history. If this summary gave you a new perspective on wealth creation, smash that like button and subscribe for more content that provides historical wisdom for modern success. Drop a comment sharing which historical era's wealth-building strategies resonated most with you. And remember, the patterns that created wealth for thousands of years still work today. The question isn't whether you can build wealth using these principles. It's whether you will. Now, go make history by applying the lessons of history. Until next time, think strategically, act boldly, and build wisely.